Hi everyone, Chris Camburn, 1406 Financial here with what I like to call market stats, which is a piece I do. Well, the last time I did it was June of 2024. Every 6 months. Perhaps I could do a quarterly, but anywho, what I do is I look at the past performance of the S&P 500 and the Aggregate Bond Index, and I try to make decisions going forward based upon historical results. So let's run some disclosures, and then I'll get into the work. So this is a project I enjoy. I'm sort of absolutely obsessed with making investment decisions. Where do we invest today to be better off in 1 year, 3 years, 5 years, 10 years, 20 years, 30 years, 40 years, 50 years? I have clients with different time horizons. Mine's long term, but not everybody's is. And also, even if you have long-term time horizons, sometimes you have money for shorter-term needs, and you try and figure out, look, if I need this money in 5 years, where's my best bet? And so what I do is just using the free information from yahoo.com and from bloomberg.com. I get historical data on the S&P 500 index and the Bloomberg Aggregate Bond Index. I put it into my spreadsheet. So let me show you. Let's just go to the punchline here for January 2025. So the results are actually through December of 2024, right? So my S&P data, and let's see, where am I best suited here? Well, I'll hang out over here, and if I have to move me or do something, I'll try and be cognizant of it. So I have S&P 500 data, again, from yahoo.com. I just exported to an Excel spreadsheet here. And it's from January 1950 to December 2024. And I put it into a spreadsheet, and I calculate the changes over different time periods: 1 month, 3 months, 6, 1 year, 2 year, 3 year, 5, 7, 10, 20, etc. And I put it into a summary table here. And run, just try and conduct some analysis. So let's start at the beginning with 1 month. Since 1950, January 1950 through December 2024, there's been 900 months, right? So 75 years. There's 75 years in this period, times 12 is 900. 900 months. 543 months have been greater than zero. 357 months have been less than zero. So 60.33% of the time, every month, the S&P 500 historically has gone up, and 40% of the time it's gone down. The average return has been 0.74. When it's been positive, the average positive month is 3.33%, and when it's negative, the average negative month is negative 3.25. So let me just clarify that there. The average return per month is 0.74. However, when it's positive, right, so when the returns are greater than zero, it's average 3.33. Wasn't expecting to see that. And in the months when it's negative 3.25. So when it's good, it's good, and when it's bad, it's bad. That's sort of an outstanding number. I'm going to have to... Well, let me check my numbers on that. I kind of can't believe those. Well, yeah, back I went to my source data. Those are good numbers. Very interesting. So the best month in the past 75 years has been 16.3, and the worst has been 21.76. Then we go through the same thing for a 1 year period. And so I find this just to be the most interesting. So for 1 year, the percent of time that returns have been greater than zero is 74%. For 2 years, I should keep that highlighted there for you. For 2 years, it's 82.53%. 3, 84 and change, 83, 92. For 20 years, there's never been a negative period, negative 20, 30, 40, or 50-year period. All right, so statistically speaking, the odds are in your favor. The odds are in your favor to invest in stocks. I'd say 60% chance of success is not bad. 74 is not bad. I mean, 80 is better. I mean, at what point do you get comfortable that, at what point do you get comfortable? So say you need money in 3 years with an 84% chance of success, but the average downturn in the years when it's negative, so if 16% of the time it loses, the average loss is 11.3%, and the maximum has been 35%. So if you have $100,000 that you need to make some interest on or what have you, or you want to know what's the best way to make some returns and you need it in 5 years for whatever your needs might be. I'm just arbitrarily choosing a 5-year period here. I mean, you can roll the dice. 83% of the chance, historically speaking, your monies will increase. The average increase will be 51%. The average increase is 51%. The average when it's positive, 64. But if you lose, your average loss has been 11, and your maximum loss has been almost 36. So $64,000 to the downside will be your net result, net balance to the downside if we have a super bad, if we tie the maximum losses. I mean, so those are, I mean, maybe you have other funds to offset this, but I'm kind of thinking about the situation where you isolate monies. So, I mean, I absolutely obsess about this. For people ask, Chris, is now a good time to invest? Is now a good time to invest? Should I wait? I mean, historically speaking, no. Now's the time. But I share this with clients when they ask that question so that they know, what makes me answer the way I do and what the risk is to investing or not. Then I compare that, then I use as a contrast, the Bloomberg U.S. Aggregate Bond Index total return. Now, this index, I only have information from January 1976 through December of 2024, so less periods. But I think you'll see, I think it's enough time to kind of see what the story is. And that is for every 1 month period, there's a 65% chance of success. Every 1 year, 86. 2 year, 93 almost. 3 year, 93. 5 year, 98. 10 year, it's never been negative over a 10-year period. And so those numbers look very similar to the stock numbers. The averages are less. I mean, the average total return for 3 years is 22%, 41 for 5, 108 for 10. And that's, let's see what the average, can I get these both on the same screen? This might be a little tight. Average for stocks over 3 years is 28, bonds 22. Stocks 51, bonds 41, stocks 120, bonds 108. I mean, so you really, you get maybe 10% more, well, 6, 10, 12% more. I mean, $6,000, $10,000, $12,000 more. I mean, it's certainly, not chump change. So, but then the downside, if you lose, your downside in bonds historically has been, say, for 3 years, almost 8%. For 5 years, almost nothing, just 1. And for 10 years, it's bonds have never had a negative return for, this index has never had a negative return for 10 years, all right, in that time period. So then the maximum, maximum 781, 151, 293, negative 15, negative 2, 764. So, again, I've gone through this for a few hours before recording this. I mean, just trying to make decisions for where to place your bets for money when you need it. I always tell people, hey, Chris, how should I invest? Well, when do you need the money? When do you need the money? When do you need the money? And let's play the odds. If you need the money in 3 years, here are your odds of success, historically speaking. And then what I did here is stocks versus bonds. We can only go back to 1976 because you can only use your shortest period. And what I just did here was if stocks have beaten bonds. I mean, so these numbers are if stocks have beaten zero, bonds have beaten the zero rate of return. Now it's versus each other, and you know, over most time periods, I mean, 60% of the time in these middle periods, stocks beat bonds. It increases over the years, I mean, which just seems likely. But again, even though stocks have a better chance of returning more than bonds, you just have to remember that when it gets bad for stocks, so 10 years down negative 40 has been the worst 10-year time period for bonds was a 7.64. That's a total return. That's not an average annual. That's a total return. So, I mean, it's just understanding what your probabilities of results are, or potential outcomes are. Come back to that one. So then I did cumulatively stocks versus bonds, right? So cumulatively, so where we have stocks being better than bonds, say, mostly 60 or 70% of the time. Well, that's percent of the time. That's the frequency. But then what's the cumulative returns? What's the difference here? And let's see here if I stat that. No. But you can see here, for the past 10 years, stocks have achieved 171% total return more than bonds. For 20 years, the 300% greater return than bonds. This is just if stocks are better than bonds. And so then this is what's interesting. I created a graphical representation here. And there are various time frames. So not all the time. If stocks are better than bonds 60% of the time, 70% of the time, when aren't they better? I mean, when have bonds won? When has the tortoise beat the hare, so to speak? So let's go back to, let's apply. This is the difference, the cumulative difference of stocks versus bonds over the time frame selected. So you can see here that if at the 0% mark, if the lines are below, if the dots are below the zero line, that means bonds have done better, and if they're greater, that means stocks have done better. So bonds did better for the 5-year period leading up to, say, the mid-'80s. The early 2000s, I mean, that was kind of the dot-com bust. The late 2000s, that was the financial crisis. And then since then, they've been on a tear. So there have been a couple periods here within the past 50 years where for 5 years, here's 91, 92, I think that was an increase of interest rates. That was a sharp rise of interest rates that allowed bonds to beat stocks for that period of time. Or it was that they raised interest rates and then for the next couple years, stocks drifted down. Well, I mean, that's what's happened to us recently, but we haven't seen that any drift down. Not to say one's not coming, not predicting, not making any forward projections here, just surmising. So let's see, for 10 years now, the 10-year cumulative difference of stocks and bonds, and there have been, again, several periods here similar to that 5-year. In the early 90s, surprisingly, in the early 2000s, for the 10 years ending in the early 2000s, bonds only beat stocks for a little bit of time, and here the financial crisis again, bonds ahead of stocks, and then stocks have just taken off since the financial crisis. Let's look at a 20-year number. Let's see here. You have to look at the time frames on the bottom. So for 20 years, again, since my data is beginning in 1975, that means my first 20-year period is 1995. So I don't have the early 90s, but we do have the early 2000s, the late 2000s, and look at that. This is very interesting. We pick up a time period here where coming up to 2018, 19, 20. The pandemic really hit. The pandemic hit in early 2020. The pandemic hit early 2020. I'd say March of 2020 is when the news was announced. So interesting that even in 18 and 19 we see this, but in 2020 I can understand. And then since then with the stimulus, other factors. Wow, I mean, so, but there have been, I think, but the point of this chart is there have been periods where bonds have beaten stocks. Bonds have beaten stocks over 20-year periods. And let's see, that again is 26% of the time, so almost one out of every once every 4 years. I mean, that's very I just find that very interesting. I mean, imagine if you're 40 investing till you're 60, you just think stocks are the answer, and here 25% of the time, it turns out bonds would have been the answer. I mean, it's just, I just find this stuff fascinating. And then let's see, for 30 years, was there a time period when bonds? Yeah, well, again, the financial crisis wreaked a lot of havoc. So into the, having purchased bonds in 1980 would have been a better investment than stocks when it came to having more monies between 2008 and 2012. Now, look, these periods are short-lived. I acknowledge that here. Maybe that's an observation you're making. I kind of think about a lot of things prior to doing this, but I make additional observations as I go along. And I mean, they're short-lived, but if you're withdrawing money from your portfolio, if you're adding money to your portfolio, this is not as much of a concern as if you're withdrawing money from your portfolio. Even though bonds will have done better than stocks, maybe for the 30-year period ending 2010, it changes course shortly thereafter, as you can see. And this is just all of them, 5, 10, 20, 30-year time periods together, where they all coincide at the financial crisis, being where bonds would have been better than stocks. And that's only because, and the reason isn't that bonds did so well, stocks did so bad. So in the race, stocks were way ahead, but came way down during the financial crisis. So it wasn't for the goodness in bonds was their stability. That was the goodness of bonds. It's not saying that this isn't that bonds did tremendously well. It's just that stocks did so poorly, and bonds did their job of not doing as poorly, right? Not doing as poorly. So just absolutely obsessed about this stuff and where to invest for the time period in question. So I was looking at a couple other things, considering to make some points, but I don't really have a short-term forecast for 2025. I mean, yields on bonds are decent compared to, the past almost 20 years now. Well, the past 15 at least, since the financial crisis and they reduced interest rates. Prior to that, bond rates were 4 or 5, something like that. And here we are again. And so what do? I mean, do you look a gift horse in the mouth and say, well, I'm going to keep shooting for 8, 9, 10% in stocks, or do you take bonds, at money market or treasuries are 4%, in the 4s for 1 to 10 years? Gosh, that's that's the kind of stuff I sit around and think about all day when I'm investing, or I'm investing on behalf of people. So so that's market stats. I mean, I hope you found something interesting here. I hope it was some sort of observation to be made, or some sort of actionable item, or something that's helpful here. I hope there's something helpful in these numbers. There's certainly a lot of them. And I use this stuff all the time to help people make decisions. So thanks for watching, and hope to see you back here soon. Thank you.